Good morning, and welcome to Investment Talk TV, brought to you by the award-winning advisors at Legacy Wealth Management. And now, with the latest information on the stock market, your investments, and retirement opportunities, here are Legacy Financial advisors Paul Meyers and Brady Brunsvold.
Hey, here we are for the 21st episode of Investment Talk TV. A big good morning to you wherever you may be, all across North Dakota, Minnesota, and South Dakota. Coming to you on WDAY and WDAZ, ABC for North Dakota. Brady, good morning to you.
Hey, good morning. Happy to be here. Another beautiful Sunday morning.
Well, you know, it's in the 30s today. That's not too bad.
Yeah, weather's turned around. Do you recall, Paul, just a few days ago, maybe a week ago now, I suppose, woke up, my truck said 31 below zero.
You know, you have a talking truck. I love that.
I'll tell you what, it says stay home is what it told me. So a little brisk. I'm happy it's turning to spring already, so we'll take it.
It is. Hopefully it'll continue turning to spring, and good things will be happening. And our thoughts, of course, go to those people in the affected states like Texas who've had to deal with water problems and frozen pipes and no power and no electricity. And
yeah, it's kind of crazy. You know, I was watching some of the, and you know, people are scraping their windshields with spatulas, and you know, everyone wants to go sledding down the snow that they got, but none of the stores had sleds because they don't
stock sleds down
so
there.
They're just not used to it, and it's just crazy the extremes that you saw: power being turned off, people's pipes breaking in their basement. They're not equipped for the snow like we are.
I imagine
here.
a lot of the snowbirds down in Texas will be moving up here to North Dakota and Minnesota, and we'll welcome them at Legacy Wealth Management. Yeah, come on down.
Absolutely.
And we'll be happy to help you, but bring some oranges with you if you can. Have you ever had fresh oranges right off a tree?
Boy, I don't know that I have actually.
Yeah, they're tremendous. They're still warm from the sun, and they're pretty good.
Juicy.
Yeah, very good. Well, anyway, welcome to you wherever you may be this morning to Investment Talk TV. We are advisors from Legacy Wealth Management, and we're happy to be joining you here on a Sunday morning like we do pretty much every Sunday morning. And, of course, we also do a radio show on KFGO and KFYR, and we kind of enjoy that, too.
Yes.
We're joined usually by Steve Poitras on that particular show. And Steve has told us he's going to come over here and be on our TV show one of these days.
Excellent.
So strap yourselves into your seat for a particular wild time. Speaking of that, Brady, I thought I would ask you right away for your favorite town in our area of coverage that we deal with.
Well, boy, there's so many to choose from. If I had to pick
it doesn't have to be your favorite. It's just your favorite this week.
Oh, a town of the week, you might say.
Town of the week, yeah.
Let's go with Jamestown, North Dakota.
Ooh, Jamestown, North Dakota.
I always like Jamestown.
Home of the Jimmies.
Yes, yes.
I wonder where they got that name.
Clever name, that's for sure. But, you know, they have a Menards nowadays, which I used to live out there years ago, and there was nothing when you were trying to do some home improvement, so it was nice to have a Menards out there. But all kinds of fun stuff out in Jamestown, North
For me,
Dakota.
Jamestown is where I stop on my way to Bismarck.
Yeah?
Not that that's the only reason to
Kind of
go there, but I
halfway
always
point.
stop there and have lunch or do something or breakfast or whatever.
It's about 100 miles from each way, isn't it?
It is
More or
about
less?
100 miles, so
Yeah.
it's a great place. Now, I was thinking of where would be my favorite town today, town of the week as it is, and I thought it'd be kind of fun to pick a different town. So I'm picking Mayville.
Mayville,
North Dakota. So if you're in Mayville or if you're in Jamestown and you want to give us a call, you can always reach us at 701-365-8083. Or, of course, you can go to our email address, which is team@legacywealthfargo.com. We would love to hear from you if you're from our towns of the week.
Okay.
And, once again, when we take a look at that map of all the places that we get a chance to contact people, it's a bit of a static map. We don't keep adding red dots wherever people come in, but boy, we have sure had a lot of contacts from people all over the tri-state area, and we appreciate that. Isn't it amazing that in spite of the coronavirus for 2020, in spite of all that, the markets have been zooming along and individual accounts have been doing well, and we don't know exactly what the future will hold, but it's been pretty good last 12 months.
Well, as you see on that map, Paul, a lot of new red dots even. And, it's been great because, at least I've seen it seems like some of the fear around the virus have started to calm down a little bit. People are getting vaccinated. We're holding, more and more in-person meetings, even though there's still a lot of virtual meetings. And it's just nice because I think people are ready to get out and escape from the jail that can be your house sometimes. So it's fun to see that. And then, like you said, the markets have been doing pretty well. Plenty of things going on as far as that goes.
Let's talk about some of those things this week. This week, lots of things, even in Congress.
Yeah, so the GameStop thing, right? The Big Short, they say there's been some congressional hearings from the House with the players, the key players, not only Robinhood, the trading platform, also some of the hedge funds that were involved as far as the ones that took short positions as we talked about on our previous episodes. And this, Congress wants to know, who's at fault, how can we fix this to make sure things like this happen again? And, the whole angle, I think, with that is that a lot of individual investors jumped on towards the end of the whole thing and ended up kind of holding the hot potato, and they're the ones that lost money. And, the biggest concern with a lot of these people is that, we don't want individual investors who don't know what they're doing losing all the money. And so it makes sense, but I think sometimes those fingers get crossed, and a little bit of a circus act when you watch those kind of things.
Well, in particular, because it was the hedge funds who were doing all the selling, causing the people to lose a lot of money.
Exactly.
And I think that GameStop was still hovering in the mid to high 40s as the week wore on.
Yeah, I think when the hearings first started, they popped a little bit. There's a couple actually individual traders who helped trying to push the price up during this whole thing, and they were talking, they were pretty bullish on it. And it's interesting because you see everybody's angle, not necessarily who's right or who's wrong, but everybody has a viewpoint. And some people are afraid to talk about it in front of Congress, and some people are not afraid to talk about it in front of Congress. So pretty interesting, and it'll be interesting to see if there's any sort of punitive decisions being made from Congress because of it.
Well, good points. And, you mentioned a magic word there, viewpoint. And one of the things that I get a kick out of at Legacy Wealth Management is that we do have some definite and strong views on your questions. Where's the market headed? Is the market too high now to invest in? Should I go in this direction or that direction?
Yeah.
Is technology still going to be strong? What's going on with small company stocks? We're going to have a viewpoint, we're going to have an opinion, and we're going to try to put that together with your portfolio to help you achieve the best that we possibly can, because that's our goal, particularly as fiduciaries. We want to do the best we can for each individual client.
Absolutely. Other than that, we saw jobless claims come in a little bit higher than expected this week. What else? Bitcoin, if you follow the Bitcoin craze, over $50,000 per coin. So I had to check underneath my bed sheets to see if I had any coins laying around, but no, I don't.
Those are the wrong kinds of coins.
Wrong kind of coins, dang it. Well, if you have some Bitcoin, you're probably smiling right now because the price keeps on going up.
Yep. Although, like Bitcoin has in the past, what happens next after it goes up?
Boy, who knows? I mean, it certainly could go down, but it seems to keep on trucking. People are talking 100,000.
Well, Elon Musk went into it big, didn't he?
Well, I think Tesla revealed that their balance sheet had something like $1.5 billion worth of Bitcoin instead of cash on hand, which is, really unheard of for a large corporation like that. So pretty interesting, and it could probably influence other companies potentially to follow suit.
I think it probably will. Speaking of interesting things going on, this week we got to report that Carson Wentz has been traded to the Indianapolis Colts.
Yeah, that's
and
interesting.
So at Legacy, we like to give away Carson Wentz jerseys. I guess, Brady, this means we're going to have to lay in a stock of
Colts
Wentz jerseys.
Nice.
Holy cow. And pretty exciting because, about an hour or so, or a couple hours actually, after our show is over today, just about the time most of you will have calmed down, the NDSU Bison open up their football season for the spring.
That's kind of nice to see.
Youngstown State.
Yeah.
Going to be big. Maybe at the end of the show we should do a prediction, Brady, and see what we think. Yeah. We do have an interesting show lined up for you today. Of course, we have our 5 points in 5 minutes. That'll be kind of fun to take a look at. We have a Legacy Wealth Management question of the week, and I think you'll find that to be pretty interesting too. And of course, you've got time to even look up the answer if you need to. We'll give you that question of the week in just a minute. Plus, since it is the start of NDSU spring football, we've got a special new feature that we're adding to today's show. It's called the Legacy Wealth Management Portfolio Makeover, and it'll kind of have a football theme. Yeah, kind of. It's like fourth down and inches, and what are you going to do?
What are you going to do?
Are you going to go for it, or are you going to punt?
Depends on who's the coach, right?
It sure does. Well, anyway, it's probably time for us now to move into our next segment, and we call it the Legacy Wealth Management Investment Question of the Week.
It's now time for the Legacy Wealth Management Question of the Week.
Well, here it is, Brady. The question of the week. It involves 3 companies.
Okay.
Would you like to tell us what the official question is?
All right, so here's the question, and if you think you know the answer, send us an email to team@legacywealthfargo.com with your guess as well as your name and contact information so we can send you your fabulous prize, by the way. Here's the question, though. Which company of these 3 is the largest market capitalization and which is the smallest? Which of these 3 companies has the largest market capitalization and which one has the smallest? The companies Walmart, General Motors, and Tesla.
Now, market capitalization is often measured by the number of shares outstanding times the share price.
That's exactly right. The share price times the number of shares is your market capitalization. So which one of those companies has the most and which one has the least? And as I said, send your guesses to team@legacywealthfargo.com, and we will pick the winner next Sunday and send a fantastic prize package.
Well, we don't want to promise too big of a
it's okay.
surprise. I did have some people come in this week who say they've been listening to us for a long time and they want to know if they're winning a new car.
Ooh.
I said, no, but we have a photograph of one. It's very nice.
And a box of Tic Tacs.
And some steak knives. Hey, folks, every week we try to take a look at the investment trends that are moving the market, and there are a lot of things out there moving the market. We like to say that it's at an inflection point right now, and that's one reason why we encourage you, if you've got questions about your investments or your retirement plan, to give us a call, because when the markets are at an inflection point, that means that things are moving, and you want to be able to take advantage of that. We call this next segment 5 Points in 5 Minutes.
Every week, the advisors at Legacy Wealth Management, with the assistance of economic researcher Mick Higley, comb the economic reports, and we come up with data and information that's helpful as we analyze the markets and put together our advice. We call this 5 Points in 5 Minutes.
And the first area that we're going to take a look at is the median return of the stock market over the last number of years. The median annual return of the stock market over the last 45 years, based on the S&P 500, was a gain of 15.8%. Wow. Over the last 45 years. The stock market has produced a positive total return gain in 37 of the last 45 years. In other words, 82% of the time. I don't know that we could say the same if we broke it down to weeks.
Probably not, yeah.
And so that's why it's important to be invested for the long term.
Absolutely. Well, I guess I'll take point number 2, and it's a similar story, except in the bond market. Number 2, the median annual return of the taxable bond market over the past 45 years, that's all the way back to 1976, was a gain of 6.5%. The taxable bond market has produced a positive total return in 42 of the past 45 years. That's 93% of the time, maybe even a little bit better than the stock market.
Yeah.
Not to the same extent, but more often anyway.
Absolutely. Here's another interesting point about the market gains that we've seen. I went back to February 12th and looked at the S&P 500. The S&P 500 is up about 4.9%. That's year to date through Friday, February 12th. Now, as a cap-weighted index, the largest capitalized stocks carry a disproportionate impact on the index's performance calculation. It gets a little bit complicated, but basically what that means is, as of February 12th of this year, the 8 largest stocks in the index, 8 out of 500, represent 25% of the total capitalization.
A bit skewed.
Yeah, so how those 8 stocks did, well, it makes a big difference.
Absolutely.
In how your portfolio did. And that's another reason why, although indexes can be helpful and useful, when you invest in something like the broad S&P 500 index, you get the good with the bad.
You get it all. That's right. All right. Point number 4. For every $1 of goods the U.S. companies exported to Chinese buyers in the past year in 2020, American consumers imported $3.49 of goods from Chinese manufacturers. So obviously a little bit skewed in the wrong direction, if some might say. A lot of people are bringing stuff in, not so much going out.
One of our favorite things that we often say about loaves of bread is that the price of a loaf of bread is going to be higher in 5 years, and we call that inflation. When you take a look at inflation as measured by the Consumer Price Index, it was up 1.4% for the year 2020. Not too shabby when you consider that many investors saw gains in the neighborhood of 20 or 25% during that time period. The category food within the CPI calculation was up 3.9% for the year. I personally helped that along quite a bit, I'm sure.
Sitting at home.
Medical services was up 2.8%, but energy was down 7% for the last year.
Yeah.
No wonder. The price of a barrel of oil was down considerably during the year.
It sure was.
But that has reversed, hasn't it, Brady?
Yeah, and I think we've been watching it quite a bit. And, that's another good point, Paul, with this whole craziness we've seen down in Texas. Another thing, there's a good potential that we might see a spike, at least in the short term, of the price of a barrel of oil.
Well, I think we have to a certain degree. The price of oil was hovering around $60 a barrel, and I wouldn't be surprised if by, let's say Monday, that it's up over $62 a barrel. It could be interesting.
Absolutely.
In any case, one of the activities that we do when new people contact us, we talk a little bit about what might change in their individual investment portfolios. Of course, we have to keep in mind that the risk and the personal profile of each client or family can be different. Not all investors are the same, and each one deserves their own individual approach to their portfolio. That's what we try to do at Legacy Wealth Management. However, having said that, today we're going to take a look at an investment portfolio, kind of a hypothetical investment portfolio, and discuss what we might do to improve their situation. Brady and I call this feature Legacy Portfolio Makeover.
It's Portfolio Makeover with Legacy Wealth Management.
Okay, well, this gets a little complicated to explain, but let's talk about it. This hypothetical portfolio reminded me a little bit of the football game that's coming up in a couple of hours on TV sets and radio sets and in person all around the valley. We thought this situation relates well to football, and here's what we mean. In football, each team is faced with individual choices. What are they going to do? Are they going to, as I said earlier, go for it on fourth down? Are they going to pass? Are they going to run? And everything that they choose to do is designed to put them in a better position so that eventually they can win the game. Now, there are rarely any guarantees in a football game, I'm pretty sure, and frankly, each decision comes with results that can be either favorable or not favorable and can impact the final outcome. Well, in the investment world, each investor or family has choices and decisions to make to move them along towards retirement, and so that they can enjoy life the way they'd like to. There aren't many guarantees in investing either, at least not that Brady and I have seen, and making the wrong decisions can definitely impact the way your position turns out. So, here's the situation that was presented to us, Brady. Now, I'm going to go through this item by item and try to explain what their situation is, and then we're going to talk a little bit about what we might do as part of their portfolio makeover. First of all, we have Harold and Hannah. I wish we had a picture of them. Delightful couple. Harold and Hannah are 66 years old, each of them. Both are scheduled to retire on July 1st. Harold has a pension at his company and an offer to buy it out from his company. Instead of receiving $800 a month from his pension, the company has offered to buy out his pension for $200,000 in cash, a one-time lump sum payment, as opposed to $800 a month. Harold also has an interest in his parents' land, which is currently paying him about $24,000 a year in income. That's net after taxes and so on. Kind of an interesting situation. Now, Hannah, not to be outdone, has a 401k that's worth about $460,000 that she got from her work. Of course, she's retiring from her work. It's been invested in a 401k the same way for about 15 years. What do you think, Brady? Is that terribly unusual?
No, it happens all the time. There's no one giving you advice, so you just kind of forget about it and let it grow, and hopefully it goes up a little bit, but it's probably not doing as well as someone was giving it its full attention.
Because as we all know, the market does change, and certainly more often than every 15 years. Now, they have one son named John, who is a physician, married and doing very well, and it's important to bring that out.
Sure.
So here are the questions that might come up in trying to do a portfolio makeover for this particular account. Question number one says, should they start taking Social Security now or wait until the age 71? Brady, I'm going to let you do the hard lifting here.
Yeah.
What do you think? They're 66, take it now or wait until they're 71?
So, generally speaking, if someone comes in and asks me that based on their situation, or even generally speaking, the first thing I go to is full retirement age. For these guys, they're probably right about there between 66 and 67. As you get older, most people are locked in at 67. So they're very close to full retirement age. Generally speaking, to me, that's the perfect time to do it. You can take it as early as 62, or you can wait and let it grow for a couple more years all the way to 70. But generally speaking, I think you're kind of hitting that sweet spot right at full retirement age. And, Paul, we used to always say when we first started doing this, let it grow. 8% basically what it grows every year you defer, guaranteed, by the way, is pretty hard to sniff your nose at. So, but I think we've changed our tune on that a little bit. We really kind of feel you take it when you need it more than anything.
And the other thing is, if you wait too long, you're leaving money on the table, for
Right.
number one.
Yep.
And number two, there are no guarantees as to how long you're going to live. And unless I'm wrong, your Social Security benefit pretty much goes away, for the most part, when you pass away.
Yeah, that's just right. So you want to make sure you're going to be around long enough to enjoy it. The longer you wait, the shorter the time you're going to have.
I think we calculated once that if you wait to take your Social Security until you're 71 or 72, that it's a good 11, 12, 13 years before you actually make up the money you left behind on the table.
As opposed to taking it at, say, 62.
Right.
Yeah.
Well, even at 66. So
Yeah.
from 66 to 71, it's going to take you until you're about 83
Wow.
to make that money up. Now, these are rounded numbers,
Yeah.
and they're typical, and it's not for everybody, and we'd encourage you to talk to your financial advisor about that specifically. But here's another point,
Okay.
Brady, and it's one that we get into very often. It's point number 2, and it says, should he take the pension buyout that's being offered
Yes,
for $200,000 in cash, one lump sum, or the $800 per month pension for the rest of his life? And Brady, you and I were talking about how we figure this out, and we can also give it to him in a kind of a simple form.
Well, if someone came in to me and said, here's my pension statement at work, what should I do? Because it's very common that they offer a lump sum buyout. It's very common. And so basically what we're looking at with this couple is it's $800 a month. That's $10,000 a year. Or $200,000 as a check that would go right into their IRA typically. Well, that's, if you do the math, that's about a 5% rate, right? $800 a month on $200,000 is about 5%. The way we look at it, we do it a little bit more complicated. We look at the net present value of that and say, well, based on an expected rate of return for a risk-appropriate portfolio, are you going to do better or worse than that number? And, if it looks better, well, then maybe you want to leave it, take that $800 a month. But if you think you can do a little bit better than, say, 5% in a portfolio that you're comfortable with on an average annual return, well, maybe you want to take that $200,000 and invest it because maybe you can do a little bit better than that. So
Right.
a lot of the times we find that 5%, which is a common rate of return that you see in a lot of those, is not the most appealing number. But on the other hand, a guaranteed check in your mailbox every month has some appeal.
And so I think the point really that Brady is making is that it's an individual situation, and we can help you with that decision. Many times people conclude that they can do better than 5%
Right.
in an investment account. And historically, although past performance doesn't guarantee anything, historically the performances have been north of 5% in many cases.
I would say that's fair, yes.
So individually, it's a question for you to consider, and we're ready to help you with that and help you figure it out. So what about Hannah and her incredible $460,000 401k? What should they do with that $460,000? Now, $460,000, by the way, invested at 8%. Is over 36,000 smackaroos, as you like to say,
Smackaroos, yeah.
per year in income.
Yeah.
What's the best move for Hannah?
Well, what you find, a lot of people, they work their whole lives, they put their money into their 401k, and then when they retire, a lot of companies, they'll say, hey, listen, you have to do something. We're not going to let you keep it there anymore. Sometimes they will, but sometimes they say, well, you have to do something. And so you can either cash it all out and put it in the bank, which you don't want to do because then it's all taxable as income for the year. That would be a big tax bill. You can roll it into your IRA typically, which is very common because it allows you to continue to invest, find someone amazing and talented like ourselves or someone else, but preferably us. And it helps to have someone there to give you advice, not only from that account specifically, but for the whole thing. And that's what we do a lot of times, Paul, is to say, okay, here's one piece of the puzzle. How does that fit in with the Social Security? How does that fit in with that lump sum payment if you take it? What about Medicare? Their health costs, because they're 66, are probably pretty low. But how does that factor in? Or if the couple is below that and they're still paying health insurance, you're talking $1,000, $1,500 a month. All of those things factor in. And if you have someone, whether it's us or another advisor, to help answer those questions, it's extremely advantageous to that couple.
I think so, too. I think talking to someone who can give you an outside opinion on that is a good idea. And Brady, I had a very similar situation to that in the last couple of weeks, where a client came in and they said, we'd been to another financial advisor, and they suggested to us that we put our money, a big lion's share of our money, into an investment that had at least a 7-year time horizon on it.
Wow. So locked up for 7 years.
Yeah.
It's a long time. If you're, say, 66 years old and you're leaving in there for 7 years, one thing, it's tough to think about, right? The older you get, the less active you become. And so what I tell a lot of people, whether you retire at 60 or 65, or in this case, 66, now is the most active you're going to be for the rest of your life.
Right.
And the longer you wait, if you have a 7-year commitment to something where you can't necessarily get that money, well, you're not going to be able to utilize those and enjoy those years. So don't lock all of your money up into something that really gives you handcuffs and doesn't allow you to do the things you want to do now that you're finally retired.
And you know what I think is particularly attractive about the ideas that Brady and I have anyway? For most people, everything or almost everything that we suggest people use as an investment is liquid, which means you may invest in it on Monday. Theoretically, you could call us on Tuesday or Wednesday and get out of it. Now, we don't ever have that happen, but you could. There's typically no penalty for getting out. There's no extra fee for that. Right. And liquidity is a big deal. I remember a philosopher from the 1900s, who I can't think of his name right now, but he said, I'm far more concerned about the return of my principal than I am the return on my principal. Yeah. And it's a good point. Liquidity can't be overstated. I've got one last question.
Okay.
Should their investment profile be conservative? And what exactly does that mean? What percent return is reasonable? Brady, those are toughies, and they're for you.
Yeah, well, I mean, the spectrum's at play. I mean, if you're aggressive, the stock market itself has returned something like 11% per year for the last 50 years. So that's on the extreme. If you're very conservative, FDIC insured savings account earns you basically nothing. So where should you be? Well, the old adage that says, the older you get, the more conservative you should be. And that's just fine because you need that money on a constant basis that you're drawing from. You don't want to draw from it if it's down 30%. That said, we tend to say, are you really that conservative? Do you really understand that a loaf of bread is going to cost you more in a year? And we're not saying we're looking for diamond mines in South Africa or anything way out of your, because we don't want you to, not be able to sleep at night and worry about your money. But again, the markets are there, they're working, and make sure that we're using them to the best of our ability.
Two things. I want some of those diamond mines in South Africa that we talk about, and we've been talking about a loaf of bread so much, I'm going to have a piece of toast and watch the football game this afternoon. That much I know. Hey, so that's our portfolio makeover for today. Good news for Harold and Hannah. I think we came up with some good ideas. I want to take a quick look at the performance of the Dow Jones and the S&P 500 and then eventually the NASDAQ too. And I think we have a nice graphic that shows how the Dow Jones average has done over the last month. Looking pretty good, Brady.
It keeps on trucking. And I think things are looking really good. The virus continues to be less and less of a concern, and things are looking up going into spring.
And let's take a look at the NASDAQ for just a second. Yeah, the NASDAQ has tailed off here a little bit in the last couple of days of this week, but still pretty strong.
Yeah, and a lot of that's, the congressional hearing scares people a little bit away from the tech sector, but in general, we're pretty optimistic there, too.
So here we are, Brady, Brunsvold, and Paul Meyers for Legacy Wealth Management. Wherever you are today, I hope you're having a great day and can perhaps enjoy that football game. You've been watching Investment Talk TV, brought to you by the advisors at Legacy Wealth Management.